Welcome to the Money Talks for Beginners podcast. My name is Frankie Ho, a money nerd. Each week you'll hear me talk about different ways to use money more effectively in your daily life to become a smarter finance person. Thanks for spending your time with me today. Now let's talk about money. Welcome to the 13th episode of Money Talks for Beginners. Today we are going to talk about how to identify different types of candlesticks and candlesticks patterns in order to help you identify trends better in terms of is the trend continuing, is it reversing, or is it undecided. Based on, of course, last episode, we were talking about how to use technical analysis to identify when to buy and when to sell stocks on episode 12 for Money Talks for Beginners. And this episode is really just like a continuation of the last episode because a lot of people use candlestick charts in order to identify trends and seeing what's happening with the securities they're buying, for instance, of foreign exchange, commodities, and of course stocks. So right now, since candlesticks charts are by far the most popular type of charts being used out there, so of course we will definitely go into more detail regarding what are candlesticks and what are candlesticks patterns and the different types of candlesticks that are out there that can help you identify a lot of different things. So first of all, let us review what is a candlestick. A candlestick is a visual tool that is used to show you what is the opening, closing, highest and lowest price, usually for a single business day or at most a weekly candlesticks that represents pretty much 5 business days, and that's usually if it's the candlestick if it's usually represent more than 5 days, is usually greater than 1 year for the candlesticks chart, but most of the time is usually supposed to represent for one single business day. So let us talk about the body. The body essentially is pretty much either a hollow color, shaded in, a stripe, but most of the time I'm going based on North America, so the body would be green if it's an up day, red if it's a down day, and there's usually there's usually 2 vertical lines actually, The first vertical line is obviously above the top part, and then there's one that's below the lower part that's called the lower horizontal line, but then the actual technical terms for them are called shadows. So later on when I start referring to these 2 upper and lower vertical lines, I'm going to refer them as upper shadow and lower shadow. That way it'd be just easier for me to describe instead of keep saying upper horizontal line and lower horizontal line. We'll just go say shadows because that's what the technical term is. So, and then in terms of body, essentially, because depending on how big the difference is for the opening and the closing price, if there's a big difference in terms of what is the opening price, for example, if it's open at $10 and closing is $15, then that's obviously going to be a big difference. So the candlestick is called a long or a big body candlestick. If it's the other way around, where the stock price didn't really move very much, for example, it opened at $10 and it closed at like $10.50. So as you have noticed that it's not a really big difference. It's only a difference of 50 cents. So it's called a short, or pretty much not a very big body, because the body represents the opening and the closing price. And of course, depending on if the candlesticks, it's an up day or a down day, that the opening and the closing price will be different. As I mentioned before in episode 12, if you want, you can go back and listen to episode 12 just to refresh some of the things I talked about for technical analysis. For the candlestick itself, if it's an update, if it's a green candlesticks, because I'm in North America, if it's a green candlesticks, the lower part or the lower body of the line represent the opening price, and the closing price is the upper vertical line, I guess you can say, for the body. So that's where the closing price is. If the red is the opposite, the higher upper line for the body and is the opening price, and the lower horizontal line or the body is called the closing price. So is the opposite of it. So hopefully that covers the most basic ideas. And of course, candlesticks can be used to help you determine what are the possible trends for the stock or for the securities looking at. Of course, it be depending on the location and the shape of the candlesticks, it could actually affect your decision in terms of do you think the stock or the security is still bullish? Is it bearish? Is it sideways? Is the trend continuing, or is called trend continuation, or trend reversal or reversing? Or is it neutral, which means they're just undecided at the moment? So first of all, we're going to talk about the different types of candlesticks that are out there first, and depending on the location of the candlesticks, of these candlesticks that appear, it will hopefully give you some sort of idea. Is the security or the stock itself, is it reversing? Is it continuing? Is it undecided? And of course, is it bullish or bearish, or just really just going up and down, going nowhere? So let us first talk about the different types of single candlesticks out there, and then later on we'll go to the different types of candlesticks patterns that are out there. Well, for the single candlesticks, there is actually 3 different types of candlesticks. So first candlesticks we're going to talk about is called the doji, where the doji and candlesticks have roughly the same opening and closing price for the securities. So when you are looking at a doji, you should look like either a cross or an inverted cross, depending on the type of doji it is. But usually you'll see like one straight horizontal line with the upper and lower shadow, depending on what type of doji it is. It could be a longer upper shadow, or a longer lower shadow, or same length upper and lower shadow. But most of the dojis will have pretty much just a flat horizontal line, because the opening and the closing price are pretty much the same, or the difference is very, very, very small, which forms a very straight horizontal line, and it will just look like a cross, or inverted cross, or it looks like a giant plus sign. And those are the type of candlesticks that are most commonly referred as doji. So the first type of doji we're going to talk about is called the neutral doji, which just look like a giant plus sign where there is a very small body, so very flat horizontal line, or just one straight horizontal line, and 2 equal length for the upper and lower shadow. And pretty much there's the same different distance between the opening and closing price, in terms of like maybe the opening price is $10, the closing is also $10, but then at one point it was up $2, and then so the highest point was $12, and then at one point it was like down to $8. So then you'll form a lower shadow that's like down $2. So then it'll be equal length of pretty much the upper and and lower of $2. So you'll see like pretty much a giant plus sign. And most neutral dojis represent pretty much indecision. So that doesn't mean anything. When a neutral doji comes up, it means that most of the time the stock is really just undecided. It hasn't exactly formed a trend. It is not reinforcing any trend. It's not telling you that the trend is continuing, or is it reversing. Nothing. It's just really just undecided. Nothing is happening. It's neutral, which is why it's considered neutral doji. It's just not doing anything. It's not going anywhere. It's not telling you anything, but it's better than a sign that's going against you. I guess you can say it that way. The second type of doji is called the dragonfly doji, where it looks like a cross with a small body, again, because it's a doji. And pretty much the upper vertical line is very short, the upper shadow is very short, while the lower shadow is very long. That's why it forms a cross. And depending on the current trend and